Today we have the pleasure of welcoming Peter Guay as our speaker. His title, the topic today is Responsible Investing, Putting Your Money Where Your Values Are. Peter joined PWL Capital in 2004. 17 years, many designations, and an MBA later, Peter is now the leader, portfolio manager, and financial planner in the Peter Guay team. Peter's very active in supporting the community and serves on the board of the Loyola High School Foundation and board of the Dépôt Community Food Centre. He was a founding member of the Emerging Leaders Committee of the Montreal Heart Institute Foundation and was president of the Montreal branch of the Canadian International Council. Peter actually has a YouTube channel called Do It Together Financial Planning, celebrating its 3-year anniversary in May 2020. He takes a clear and practical approach to keeping your financial life in order. We're really happy to see you today, Peter, and the screen is yours, as they say.
Thank you. Thank you, Susan, very much for that introduction. I realize in my bio, I have a little tweaking to do, and there's a date in there that's perhaps needs some work, but I really appreciate the opportunity to be here and to speak to you all. This is a topic that we've been working on for many, many years. And Tony, among you, was at the forefront of this several years ago. And I'm going to actually start with that. But let me begin by putting up the slideshow so that you can all see, hopefully you can all see this now on your screens. You should see a cover slide that says responsible investing, putting your money where your values are, with a butterfly on it. Is that all right? Can everybody see that?
Yep.
Wonderful. So this is a very timely discussion. As I'm sure you all know, Canada has just recently released its emissions reductions plan with a focus on how to make our housing stock more efficient, how to improve transportation infrastructure, the notions of carbon pricing that are crucial to achieving our net zero targets for 2050, and many other parts to it. The Intergovernmental Panel on Climate Change also came out with their 6th assessment report over the previous couple of months, and that has made it abundantly clear, and the science is incontrovertible over the fact that that climate change is human-driven. It is caused by human factors above all else. And that there's an imperative to that we start to act. And of course, last Friday was Earth Day. So all of these things coming together, making it very timely. I will keep the presentation, try to keep the presentation quite focused and walk you through a few pieces. One, where we've been on the topic in the past at PWL, a discussion of PWL strategy and how we look at that in conjunction with topics of ESG, or environmental, social, and governance investing, and then walk into some of the methodologies to apply it, how it impacts some of the core sort of parameters, diversification and performance in portfolios, and then a review of the guiding principles of how we implement it. So to start off, PWL's history with responsible investing, and I mentioned, Tony was at the forefront of this back in 2006. We hosted a fellow by the name of Michael Jancy, who was a pioneer in responsible investment and particularly environmental, social, and governance investing in the very early days of when this was being implemented. And he created the first index in Canada to filter on, to sort companies on their environmental, social, and governance rankings and scores. And so Tony invited him to speak to PWL back in 2006, which he did. And at that time, we were implementing funds based on his index in our portfolios. He actually now sits on the UN Principle for Responsible Investing board, which is a the UN global organization that large investment managers sign on to as a commitment to improving their environmental, social, and governance practices. So, we've been at this from a long time, and Tony very much a pivotal part of that at PWL. More recently, we wrote a white paper in 2018 on called "Doing Well by Doing Good," where we looked into a deeper dive into some of the research that had come out to date at that point on the impact of socially responsible and environmentally responsible investing. And 2018 was also a pivotal year because Vanguard, for the first time, released new exchange traded funds that really changed the game for portfolios. They provided a very highly diversified at very low cost approach to being able to implement this. So that really it was an inflection point for individual investors to be able to apply these theories to their portfolios. The following year, we launched an ebook on responsible investing, which all of these are available on our website. And just last Friday, actually, I released an interview that I did with a woman named Alison Slater at the Global Risk Institute in Canada. And she's the director for sustainable finance for the Global Risk Institute. So I'd be happy to share all of this good material with you after the fact. And perhaps, Susan, I could email all these links to you and you could share them among the membership if you like, if you want to dive deeper into some of the things that I'm going to touch on today. So the question of strategy versus preference. So the first thing I want to touch on here is responsible investing is not an investment strategy per se, in that it is not something we undertake because it will necessarily improve or make returns better or worse. Right? It is a preference that we apply to portfolios to match up with investors' values, to match up with investors' preference to allocate their money towards companies that are doing better things for the environment, and not allocate their capital, their investment dollars, to companies that are doing bad things for the environment or for society. So I just wanted to create that contrast where at PWL, we have a very well-defined investment strategy, which is actually, I'll give a brief overview on the next slide. We fundamentally believe that stock markets work. So we want to own the entire stock market around the world. We want to own 8,000 to 10,000 different stocks in our portfolios. And the academic research is quite clear on how efficient stock markets really are, and how difficult it is to beat the market on a consistent basis. So we very much rely on the academic research in this regard and apply this to our portfolios. And the research further shows that if you apply certain tilts, you favor certain types of companies across the 10,000 companies we own around the world, that we can generate a little bit better return by doing that. So we tilt towards value stocks and smaller companies across those 10,000, because the academic research shows that we get paid a little bit more for doing that. Not true necessarily every single year, year after year, but over long periods of time, you'll capture that benefit. So all of these strategies that we apply that you see on your screen, whether it's for a client who does not want socially responsible or who does want socially responsible investing, these apply regardless. They apply no matter what. The question then is, how do we overlay the preference for environmentally and socially responsible investing on top of these strategies? And so that's where we get into more of the sort of implementation questions and how's it going to work. So give you a quick overview of what that looks like. And as I go forward, you'll see the acronym ESG very, very often. ESG, again, refers to environmental, social, and governance, which are the three main pillars of responsible investing. All right. So this is an overview of the different ways that you can think about applying a preference for certain types of companies to your portfolio. And I'll address each one in turn. So negative screening or divestment is what we hear about probably most in the news. The big pension funds, have come out with, many of them, most of them have come out with announcements saying, we are divesting from fossil fuels. We are not going to own companies that are involved in the oil and gas business anymore. The Caisse de Dépôt has done this recently. CPP investment board, same thing. So these are basically saying we're going to remove the bad actors from the portfolio, and we're just going to keep the remaining universe of stocks to work with. Right. And that can be everything from, commonly you hear about fossil fuels, getting rid of, carbon exposure in the portfolio. You hear of the sin stocks, alcohol, tobacco, adult entertainment, things like that. Or also weapons and anything to do with conflict and arms that are common exclusions from portfolios or divestment targets. And that works well. There's some things that become debatable. And if you want a very, very diversified portfolio, and a low cost portfolio above all, in order to do this, you might have to accept some exclusions that you might disagree with, or some exclusions are very debatable. Some people, I'll give an example, nuclear, the nuclear power industry. There are many who believe that in order to reach net zero, nuclear has to be a part of that solution. And my mechanical engineering background, I actually kind of agree with that. Whereas others will say, no, nuclear is dirty, it's risky, it's not good for the environment, and it should not be part of the solution. Similarly, stripping alcohol companies out of portfolios, that tends to generate a bit of debate. And I like a glass of wine on a Friday night, or during the week as much as anybody else. Why would I not invest in alcohol companies? So some of these questions around divestment or negative screening, how you establish your criteria is a big part of that discussion when you think about negative screening. The next one, ESG integration, is something that the majority of investment managers will say they do. And that is that whenever they're making a decision about a stock, whether they should hold a stock or not, they are taking into consideration how the company behaves on an environmental level or on a social level with respect to their employees or in the communities they operate in. And that will form part of the overall data that they're considering in making a decision about company X, Y, or Z. So integrating ESG as one among many factors in how they're either going to make that purchase or not decision, and how much they're going to buy with respect to the rest of the portfolio, the weighting of that company in their portfolio. When I think about index investing, which is where we spend most of our time, that really comes in where there are large index providers like MSCI or Sustainalytics or FTSE Russell that provide ESG scores. And they go out and they score a vast array of publicly traded companies and say, these companies get a score of whatever the score they assign to them. And then they create indexes based on those scores, where those companies that score higher get a higher weight in their fund, and the companies that score lower get a lower weight in their fund. And that's how the index is created. So integration is probably the most common technique for considering ESG criteria. I put engagement here, and this is also one that most large asset managers are involved in, which is engaging with the board of directors of publicly traded companies to get them to improve their practices. And there's been lots of shareholder engagements, particularly on executive compensation from a governance point of view, diversity at the board level and independence at the board level, and engagements around social issues, particularly with mining companies operating, some mining companies operating in South America that have not had particularly good practices, where large investment managers and asset owners will engage with the board, and prior to the AGM, let the board know that they expect to see certain changes in the way the company is running in order for the board of directors to get their vote. And if the company doesn't change, then these large asset owners can have an influence. And some of the biggest ones today in this are Vanguard, BlackRock, and State Street. These are three very, very large investment managers that, when you think about the US stock market, they control upwards of 20% of every company together in the US market. And so they have a huge influence with the boards of directors of these companies. Another way that engagement, just an anecdote here, in my work with the Loyola High School Foundation, I spent some time talking to the Jesuits for the Canada Jesuit organization, and to ask them how they were doing it for their portfolio. And they had a great, Father Rye had a great story about how their strategy is they buy in their portfolio 2 or 3 companies that they particularly want to engage with and get them to change their practices. And they specifically target those board members who went to Jesuit schools. And then they interact with those board members, and prior to the AGM, they really sort of, apply their influence that way and get them to those companies to change their practices that way. And I thought it was kind of a neat example of creative ways to engage with boards of directors, even for an organization that's not necessarily an influential voter in terms of the number of votes they have with the board, but they found more creative ways to exert influence and get the board to behave better. So, so all sorts of interesting things going on in the engagement side of things of ESG. Positive screening is sort of the opposite of negative screening. It's where, as opposed to just excluding the bad actors, positive screening is focusing on only the best actors, either in every industry or focusing on those industries that behave, that are at the forefront of socially responsible or environmentally responsible investing. Things, you know, there are positive screening strategies that do still buy oil and gas, but they only buy the best behaviors. So some oil and gas companies, for instance, set really high internal prices on carbon and use that as a benchmark to make their decisions. And so positive screening is really just going after the best, the companies that behave the best, and voting with their dollars to say, we really support the way this company is changing, even though it's in an industry that's traditionally not environmentally friendly, but they're changing that industry for the better. And so they're willing to allocate their dollars that way. Thematic investing is following specific themes like women in leadership or inclusion and diversity, and buying companies that are showing leadership in those areas, or companies that are positively changing, you know, positive technological or other ways to address climate change. And so buying a subset of companies in the market that invest in those themes. The last two, you may say, well, impact investing typically is more a space where foundations get involved, because impact investing is where you're really aligning your investment decisions with, for instance, the UN Sustainable Development Goals. And you're saying, I want to align with these very specific objectives, social or environmental objectives. And so I'm specifically going to seek out investment opportunities that further the achievement of those objectives. And I'm willing to sacrifice a little bit of return to get to help further those objectives. So to my mind and to most, impact investing is saying, I'm willing to take a lower return because I want to make sure that the world advances towards achieving these social or environmental goals. And when I think of some of the conversations I've had, the McConnell Foundation is particularly sophisticated in this. They've done some really good work in this area. I sat with a fellow from McConnell on the Loyola Foundation board, and so got to know what they were doing there. And it's really a deep area of research. I could talk about that for quite a while. The last one I put on this list, donations, is in some sense the extreme of this spectrum. I started on one end with negative screening, which is the first step. And if you go all the way through to impact investing, where you forego return to create an impact, well, the ultimate next step there is just giving money away to those objectives and goals that you want to see achieved, to charitable organizations. And I had a conversation recently that kind of opened my eyes to this continuity between impact investing and just donating money. In this case, an executive director of a more recent foundation in Montreal that was telling me that they were having trouble drawing the line between what they should consider impact investing versus what is just a grant from the foundation and giving money, because the government looks at those two things very differently. And in fact, in the most recent budget, the government has said that foundations now have to distribute 5% of their capital on a rolling 2-year basis, where it used to be 3.5%. So the most recent budget has had quite an impact on foundations, and it's going to impact the way foundations think about, well, should I be considering this an impact investment where it does not count towards my 5% disbursement rate, or should I just give money to this objective and find, organizations to grant money to, and it qualifies for my 5% disbursement quota. So there's some gray zone there that I think a lot of foundations are trying to figure out and trying to understand how best to fit those things together and understand that spectrum. So those are the different ways in which the preference for investing responsibly can be applied in a portfolio. So let's just take a look. Next step here is to think about, if we do apply these concepts to portfolios, what impact are they going to have, right? And there's a lot of research being done in this area. So a lot of research coming out more recently, since even the piece that we did in 2018. But to start with just ESG and diversification in a portfolio, at PWL, we believe that portfolios should be very, very broadly diversified. I'd say extremely diversified compared to most. And step one is, yes, we can implement preferences for socially, environmentally responsible companies and still remain global investors in all markets around the world. And we can still hold thousands of securities while we do it. So those two types of diversification, it doesn't really impact. But when it comes to things like factor weighting and sector weightings, then it does start to have an impact. So at the beginning, I spoke about PWL's investment philosophy, where we buy essentially all the stocks in the world, and then we tilt towards value companies, and we tilt the portfolio towards smaller companies. Those are called factors. Those are called dimensions or factors to which you can tilt in order to achieve a higher return over the long run. Think of it as just putting the odds in your favor a little bit. Well, a lot of research is being done now on the breadth of ESG funds in the marketplace that you could buy, to see if they generally tilt in one way or another on a factor basis. And the study I'm quoting here, Madhavan, Sobchik, and Ang, came out last year, where they looked at 1,300 different ESG funds in the US marketplace. And they compared them to indexes that are tilted to various factors, known factors in the investment world. And the results they came up with were that funds that were particularly focused on social or governance issues didn't have any noticeable tilts. They generally resembled the market in terms of their factor tilting. Environmentally focused funds particularly did tend to have a systematic tilt. They tended systematically to tilt towards what are called the quality factor and the momentum factor. And so the returns of those funds, in other words, were more driven by the fact that, yes, these tilts towards stocks with more momentum. In other words, stocks that tend to do well will continue to do well. That's the momentum factor. Or quality stocks that either have very, very stable earnings, or stocks that have very low debt to equity ratios, things like that. That's really what drove the return of those ESG funds, right? So when it comes back to this idea of diversification, it's, yes, okay, if I'm going to implement an environmental screen over my strategy, then I'm inherently going to be biasing my portfolio a bit towards quality and momentum factors. That's okay, but not a big problem there. The other thing to be very aware of is that it generally will imply a sector bet, right? And the first one's obvious. If you're an environmentally conscious investor, you are highly likely to hold a lot less exposure to oil and gas and fossil fuels in general. And over the very long run, that's not an issue. Over the very long run, that'll wash out in the returns that you're going to get, such that you'll be no worse or better off over 10 and 20-year periods. In the short run, though, yeah, it has an impact. And this year, we're seeing it particularly, right? The fact that, with what's happening in the Ukraine, price of oil and gas, price of all commodities has come up substantially. So this underweight, this implicit underweight that environmentally conscious investors will have, has meant that, yeah, returns in 2022 so far have been a bit weaker for the fact that they hold environmentally conscious portfolios. On the flip side, for the previous 4 or 5 years, that was a positive contributor to returns because the oil and gas industry was doing terribly the years before. So it's important just to be aware of the fact that over the long run, it's not a problem, but over the short run, it can mean some pretty big differences in return. The same is true with technology stocks. Environmentally conscious portfolios tended to bias upward or hold more tech stocks, which was really good up until the end of 2021, or sorry, up until the end of 2020. And then 2021, 2022, that's starting to be a bad thing because tech stocks are getting hit harder than most this year, right? So the point here is being a responsible investor. Over the long run, performance is driven by the ultimate factor weights of your portfolio. In the short run, it does mean you're probably going to deviate from the market return. You're going to have what we call tracking error in your portfolio. Your return is going to be different from the broad stock market index. You know, you see the TSX on the news every night, or you see the S&P 500 on the news. Your portfolio is going to diverge from that in the short term because of the tilts that being an environmentally conscious investor implies for your portfolio. But let's dive a little bit deeper on the performance angle. And there's a bit of a history to walk through here just to set this context. There was a pivotal paper that came out in 2008 that was very widely quoted. And this paper, written by Fabozzi, Ma, and Oliphant, came out to say, if you only own a portfolio of the so-called sin stocks, this is sort of alcohol, tobacco, firearms, adult entertainment, that portfolio outperformed the stock market. And therefore, by definition, if you omit those from your portfolio, you will underperform the stock market. And that had a big impact on socially responsible investing or environmentally responsible investing for quite some time, because everybody said, oh, well, you know, I'm going to underperform the market by being an environmentally or socially conscious investor. Then, you know, then it implies the question of how much am I willing to sacrifice to be a responsible investor? And that's not a very comfortable, it's not a very nice thing to have to consider, to say, well, you know, isn't there a way I can do this without sacrificing return? Further research has nuanced this a lot more. And in fact, some of the more recent research has come out to show very specifically that, in fact, the sin stocks, the outperformance of sin stocks, had more to do with their factor loading than that they were just sin stocks. In other words, the sin stocks tended to be value stocks for one, and had other attributes that if you adjust for the fact that they have those factor tilts to the type of stocks that they are, then the outperformance actually disappears. So it removed that problem of, if I don't omit these, I'm going to underperform. What it now comes to is, no. I can omit them. And as long as I'm still a value tilted investor, I can still get the same performance, even if I omit these sin stocks. So this is really a good progress. This 2008 paper by Fabozzi has been largely discredited. And in fact, Fabozzi himself has come out to say, yeah, it's true. I subject to these new peer review process, I realized that 2008 paper didn't consider all the factors. Moving forward, there's been some really interesting research on how efficiently the market incorporates climate change into pricing decisions. So these two next ones, climate change in municipal bonds and climate change in real estate, both of these papers have shown that in the first case, municipal bonds for municipalities that are coastal and subject to potential loss of ocean levels rising, pay a higher interest rate, have to pay a higher interest rate on their bonds as a result of that fact. So the fact that there is a long-term climate risk to these communities means that their municipal bonds are more expensive to them because investors know they're going to have to face these problems. And what's interesting is it only applies to the long-term bonds of the issue. The shorter-term bonds don't pay that extra interest rate. They don't suffer that cost because the climate change is a long-term problem. It's not a short-term problem. So there's really some quite strong evidence showing that, in other words, the market is already digesting and is already pricing in the climate risk very effectively. And the same is true on real estate. When you look at studies on real estate in coastal areas that are going to suffer from ocean level rising, for comparable properties, the ones that are oceanfront and subject to that, the prices are, they're selling for lower prices than very comparable properties that don't have the same issue. And so some very, very significant studies that all just point to the same direction, which is whether it's the real estate market or the bond market or the stock market, investors are keenly aware that climate change is real, it's happening, it's a risk, and they're pricing it into their decision-making. So what that says, at the end of the day, it sort of counteracts this notion that if I invest socially responsibly, I should get a higher return than the market. What it's really saying is it's already priced in. The last paper that I'm quoting here, it's very similar to the first one I quoted that does a survey of ESG funds out there. And what it discovered, Plage and Grimm, 2 years ago, really discovered one of the things I said earlier, which is the overweight and underweight by sector washes out over time. It doesn't affect long-term performance. And the other key thing was that ESG funds, you can buy environmentally conscious funds of many different colors and stripes. But at the end of the day, it's whether the individual fund tilts towards value versus growth, or small versus large companies, or momentum versus not, or quality versus not companies. That's really what's going to drive your return. It's not the fact that it's just an environmentally filtered fund. It's the underlying factor loading that drives the return. And so this progression in thinking around performance of socially responsible investing takes us to a place today where we understand that we can apply this preference to portfolios. We know we're going to put up with, in the short term, some deviations from the market return. And we accept that fact. It's part of being an environmentally conscious investor. But over the long run, you're still going to capture the market return and whatever factor loading you've got applied to that portfolio. So for us to make this a reality for clients and put it together, it comes back to our base principles where we want to maximize diversification as much as possible. We want to hold thousands of companies in our client portfolios, but subject to a set of constraints now. We want to exclude the bad actors. We want to reweight companies according to how well they're behaving. And we want to minimize the greenhouse gas emissions of the portfolio companies we own. So we want to focus on companies that are lower emitters and strip out the higher emitters. And by stripping out oil and gas, you take a big step in that direction already. But there's a more tangible and direct relationship between achieving net zero and minimizing greenhouse gas emissions in the portfolio you own, not only of the current status, but the future potential emissions of companies. For example, companies that have oil reserves that haven't been tapped yet, that's a future source of greenhouse gas emissions that's not actually in today's numbers yet. So PWL, our focus is get as broadly diversified portfolio we can, but subject to these constraints to make sure that we are allocating investors' money to companies that they are comfortable allocating their money to and not to companies that are behaving badly. And along the way, minimizing cost, making sure we're doing this through funds that charge very low management expense ratios. And that's why I say Vanguard in 2018 really kind of changed the game on this one. And a lot of other companies have now followed suit and offered very low cost alternatives to do it. And then make sure that we're getting the overall factor tilts that we want in portfolios that the academic research has shown us is a favorable way to tilt our portfolios, to put the odds in our favor. So once we've achieved step 1 and step 2, we make sure that we're still buying a set of companies that overall is tilted towards value companies and tilted towards smaller companies to capture those premiums in our portfolio over the long run. So that, in essence, is the review of where we've been, what the research has shown over the years, and at a high level, how we do it at PWL. So I will end it there and I suppose open the floor to questions if anybody would like to ask.
Did you want to stop your share screen, Peter?
Yes, there we go.
Wonderful. Okay, thank you. All right, the floor is open to questions. We do have a couple in the chat. They are, I don't know if you can see that, Peter. Jim Fairs is asking a question. Would you consider that one?
Yep, perfect. Yeah, let me step right on that. Would you consider that the really big investment managers controlling 20% plus of the market have any influence on the social and political world in the same way that lobbyists from both left and right influence our lives? Interesting. So there's been the 20% controllers, the Vanguard, State Street, BlackRock. BlackRock is, many investors know it better as iShares. They own iShares ETFs that we use in our portfolios. Those three companies control, as I said, 20% of just about every public company out there when you put the three of them together. And they swing a really big stick. The bulk of their money is in index funds where they don't have a choice of which companies they can buy or not buy. They have to follow the index. So BlackRock, Vanguard, and iShares and State Street are not actually deliberately able to select the companies because most of their product is by a third-party index provider that determines what companies it has to hold. But they can exert influence by the way they vote their shares. And those three companies have become under increasing pressure to demonstrate that they're voting those shares responsibly, that they're voting in favor of better board independence, better board diversity, better environmental disclosure, particularly climate disclosure, and overall augmenting the efficiency of markets by making boards more accountable to investors. And that's been a positive movement. When you look at the number of votes that they have engaged in, the number of company engagements that they've had, and the number of shareholder resolutions or board resolutions that they've voted on, it has increased tremendously over the last decade and more. And so to come to your question, Jim, that's a bit of a roundabout way. Are they able to accomplish the same thing that lobbyists from left and right are accomplishing through their votes? I mean, I don't know that I can answer that question, Jim. The level of influence of the allocators of capital versus the level of influence of industry lobbyists. I wouldn't know how to quantify that. I wouldn't know where to start, what data to start looking at to say, how do I compare the two? But the movement for the capital allocators, when you look at what Mark Carney is doing with the Global Financial Net Zero Alliance, and some of the work already be done. I mean, the Caisse de Dépôt was a leader in this locally, where they really pushed the agenda and got a bunch of large pension funds to commit to much more aggressive environmental targets on their portfolios. That ultimately makes board of directors listen, and that ultimately changes company practices. So I tend to side with the capital allocators side of the coin, because if your source of capital is telling you got to do something, otherwise it's going to be much more expensive for you to operate your business. That stands people's attention pretty quickly. So I mean, I follow the money, to put it crudely. And if the money's going one direction and you're not, I have a sense that that's the more powerful force in the marketplace.
That's good for me. Thanks, Peter.
Yeah. And then Charles has asked, do not think so, as nothing affects all more than, right. Yeah. Charles, we could continue talking about it. Yeah.
Okay, Peter, thank you. Rod has his hand up. Rod, did you have a question?
I did a bit of a comment. Peter, I only spent 47 years, 4 months and 4 days in the investment industry, so I may not be very knowledgeable. I started investing in green energy 25 years ago. Not one company ever made it to anywhere. I'm a skeptic, a contrarian. I think people will realize in a few years' time, there's a real backlash against the fossil fuel debate. And it's ironic that Norwegian International Fund is disposing of its investments in oil, even though all its money came from oil. If you want a different viewpoint, there's a very left-wing activist movie maker, Michael Moore, who's made a documentary movie called Planet of the Humans. And here's a left-wing activist showing you the stupidity of some of the investments made in vast acres of wind power that have all been crapped out. You can't recycle the blades, and you've got concrete pads and biomass when you're destroying forests. And does anybody remember why we have plastic bags in the grocery industry? It's because the green huggers 45 years ago said, you can't cut down trees to make paper bags. We've got to go to plastic. Well, now it's reversing. You know, the world goes around and around. But I think people are going to really regret their absence in the oil and gas industry, which is trying to clean up its act, in Canada certainly, maybe not in every country, but I'm glad I'm a contrarian and I'm heavily invested in oil and gas.
Yeah, I completely understand what you're saying, Rod. The conversation that I had with Alison Slater recently, she addressed an issue that is very important, which is the concept of transition finance. Right now, there's been a big wave towards green investing, investing only in companies or green energy or things that are promoting the more sustainable way of life. But the reality is, yes, we have to transition a lot of industries over the next 30 years. And that means investing in some things that on the surface appear to be dirty, but to help figure out how to get off of those things or how to evolve those things towards a better and more sustainable future. So we're not going to shut off oil and gas tomorrow. It's just not realistic to think that we can turn off the spigots tomorrow. And
who don't want it?
But there's not enough renewable energy out there to do it. And we all know that. It's going to be a very rocky path to net zero. Absolutely. The transition is going to, this is my hunch. I don't have any data to back this up, but my hunch is the commodity cycle, the oil cycle, is going to get more volatile as we go forward, as we go through these swings of investment in green capacity and reduction in use. But then, the divestment in oil, in some senses, has created the high oil prices today because there hasn't been enough investment to supply the demand, and demand is post-pandemic has shot back up again. So I completely agree. It's going to be a very volatile path to get to net zero over the next 30 years. But and responsible investing also does go through waves. And some of the things I talked about, back in, there was an upswell through 2004, 5, 6, 7, but 2008, the crash, the great financial crisis, and the Fabozzi, Ma, and Oliphant paper that came out did put a dent in the sort of fervor for responsible investing. And it only really recovered in sort of 2013, 14, 15, and gathered momentum since then to become very prevalent through recent times. So I don't deny that it's not immune to the fact that these trends do go through ebbs and flows. The trend of responsible investment goes through ebbs and flows over time, but over the long run, it's been a positive trend once you sort of account for the ups and downs of it. And it is a necessary transition. But there are these issues that transition finance specifically that we're going to have to deal with, where the perception is going to be funding industries that are dirty, but we've got to make it allowable to fund dirty industries with a view to transitioning them towards more sustainable futures in a realistic way, as opposed to a turn the spigots off tomorrow kind of way. And the last comment,
the environmental impact of providing for what is required in electric cars, lithium mining, copper mining, iron and steel, cement for wind platforms, etc. All are huge environmental impacts, which the Greens don't tend to think about. All they think about is the end result. Oh, we're going to have green electricity. Well, there's an awful lot of non-green that goes into it before it becomes electricity.
Peter, did you want to make any closing remarks to tie this up?
Just to say thank you so much for your time and appreciate the questions. There are a lot of challenging questions around this movement and what the best way is to go about it. And I'd be happy to continue the conversation with anybody who'd like to after the fact. So
Wonderful. And of course, you do have your YouTube channel, right?
yeah, that is right. And you'll see there the most recent the interview with Alison Slater specifically. Yeah.
Wonderful. So I have the pleasure of thanking you, Peter. Thank you so much for bringing the breadth of your knowledge and your enthusiasm to the club today. And healthy debates aside, I am very encouraged to hear that social responsibility and profitability are not mutually exclusive. And that message is an important one. So thank you very much, Peter. Thank you.
Thank you.